So if you are a business owner looking for funding over the next few minutes, we're going to unpack a variety of different options that might suit you. Now, interestingly, 70% of business owners can't access funding the conventional way. And when I say conventional way, I'm referring to banks and private sector funders, even some public sector funders, whose mandate is to help the business community because that is where the big part of employment opportunities for the country comes from. Now, just to touch on that, government, they do assist small businesses. They do assist you with funding. They are mandated to do that. But the term SMME stands for small, medium, and micro enterprises. Now, a small business, by definition, is an organization that has a turnover between 5 and 15 million rand per annum. So most people that are entering the market are not necessarily small businesses. They're what are seen as micro businesses. Now, if you are a micro business, that means that you turn anywhere between 0 and 5 million, and that is where you are seen as high risk. So the banks don't necessarily want to touch you. Funders don't want to be associated with you. They feel that you might not be strong enough or big enough to be able to afford the repayments, or they feel that you don't have the necessary business acumen to carry that weight of funding and add that extra bit of financial pressure to your already strained business model. This is based on the experience and this is based on the perspective. So in the show today, we're going to unpack a variety of different options that might be suited to you. So if you don't have a good credit record, if you don't have any credit history, or if you don't have collateral, don't be too perturbed by that just yet. We're going to look at options that might be a little more suited to where you are in business. But before we do that, let's talk about the private sector funders and what they are about. So private sector funders are non-government funding institutions. Here we're looking at organizations like GenFin or Business Partners or Get Funds or traditional banks. And what they would need is they would need you to comply with a prerequisite or with a preset of rules and milestones. And if you don't have this, automatically they won't consider you to be an eligible client. Now, I'll go through a list of what they look for in terms of qualifying criteria, but I just want to touch on the other forms of private sector funding as well. There's also something called equity funding, and there the terms might be a little more relaxed because it's based on business viability, not necessarily the red tape that a lot of the bigger organizations like banks expect you to comply with. Let me give you an example. If you're looking at equity funding consists of venture capitalists or angel investors, and these are guys that see viability in your business, whether you are a startup, whether you are an existing business and you're looking at raising some capital to scale and take it to the next level. They will look at those factors. They will look at the viability of the business and make a decision based on that. So if you have missed some payments in the past and it has adversely affected your credit profile, they don't necessarily see that as a problem. What they are more interested in, however, is that you have a business, you have a proven market, you have a sales strategy and system in place, you have some historical data that also gives them more confidence, and you have financial records of the organization and that is signed off. And that would then give them a level of confidence to say, okay, cool, let's have a look at this. Let's see if you have the affordability to pay us back, or maybe if the investor actually wants to get their hands dirty. They call this smart money instead of dumb money, where they just give you money and they expect a return on investment with regard to that. So with smart money, they might be able to open up doors for you. They might be able to have some influence within the industry. They might be able to help you or mentor you or give you additional non-capital resources in addition to the funding that they've given you. So that is another example of private sector funding. And then the last one under this category is ESD funding. Now, I just want to pause on ESD for a second. Firstly, what is ESD? ESD stands for Enterprise and Supplier Development, right? Now, Enterprise and Supplier Development stems from the triple BEE codes. Now, forgive me for bringing race into it, but it's particularly relevant if you are a business in South Africa and you're looking at acquiring funding or funding equivalents. And if you are looking to procure this from, let's say, previously white-owned organizations or white-owned organizations, they need to comply with some of these BEE codes. Now, I'm going to slow down a little bit here because this can be a bit complex. When a white organization wants to increase their BEE scoring, they would need to comply with 5 different pillars, right? Part of these pillars would include them promoting black-owned or black businesses into management positions or into directorship positions. And when I say black, the government's definition of black is black African, colored, or Asian. And Asian is both Indian and Chinese origin. Right. So when they promote these individuals into management positions or into directorship positions, these are all ways they can increase their triple BEE scoring, their ranking. Now, level 1 is most compliant. And when a white corporate is a level 1, it means that they have an increased chance of procuring government contracts. They get additional benefits. So it is in the best interests of these companies to get as close to a level 1 as possible. So level 1 is seen as most compliant and level 8 is seen as least compliant. So obviously by them, if they start at level 4 and they increase their triple BEE points. That means they get closer to level 3 and then level 2 and eventually level 1. The fastest way for them to get from where they are to level 1 is ESD. This contributes to about 40% of their BEE points. Now, if you are a black-owned business and they procure your services, that means they are getting involved in the preferential procurement program. And this is where ESD comes in. So picture this. Let's say a white-owned organization spends 5 million rand a year on a white-owned courier company, and they spend about 100,000 rand on your business, which is a black-owned courier company. If they decide that they're going to give you the 5 million rand contract, you being a black-owned business, and the 100,000 they will give to the white-owned courier company, their triple BE points will skyrocket as a result. But now they also understand that by giving you 5 million rands worth of business, you might run into capacity issues. So with that, they might be able to give you additional funding in the form of interest-free loans. They might be able to give you additional support in the form of mentoring or any other resource that you feel that you might need to adequately supply the organization. So that is where ESD funding then comes in. So in the private sector funding, there are three main categories that we've unpacked within this few minutes. The first one is traditional loans by banks and private lenders. The second one is through equity funding, which is what we've discussed now, through venture capitalists and angel investors. And the third one is ESD funding. So those are the three subcategories under the private sector funding category. The second one I want to unpack is public sector funding. Now, public sector funders are government funders. Now, this can come either in the form of loans or in the form of grants. Now, grants is slowly but surely being phased out. I think there's been a lot of abuse of this type of funding in the past, where companies accessed 1.5 million rands worth of grant funds, and then a lot of that money weren't used for the business. You'd see the business owners going on very expensive holidays or buying themselves lovely new vehicles, and these are not government or these are not business expenses. So government has clamped down on that quite a bit. The more popular way is through loan funding. Now, there are certain ministries and organizations within government that is mandated to do this, and some examples are the IDC, CIFA, which is Small Enterprise Funding Agency, the NYDA, if you are youth, and youth is between the ages of 18 and 35, so that stands for National Youth Development Agency, and then you have the DTI, you have the NEF, which is the National Empowerment Fund, and there's a variety of other funders that is within the government sector. So to go and get more information on that, you can go to the government website and see what grant funds are available, what loan funds are available, what industry-specific funds are available. So if you are in agriculture, as an example, there is a specific fund that is mandated to assist and support that, but there's no guarantee that there are grant funds available, and there's no guarantee that just because it is government and they are mandated to help businesses get to the next level, there's no guarantee that you will get those funds. In fact, my experience when I was in the manufacturing space and when I was still a youth-owned business, when I applied to 12 of these government agencies, and only one of them actually assisted me. And they assisted me, which was the NYDA. They assisted me with about 50,000 rand for a machine and for some stock. So do not think that because it's government, you can just willy-nilly apply and you're going to get 5 million rands worth of funding. The process and the criteria is still very strict and very stringent. And then there are other forms of funding as well. Now, before we get to the other forms of funding, which I'll speak about in a second, I just want to look at the usual qualifying criteria which both public and private sector funders would require of you. Now, keep in mind that I've only listed about 7 points here, but if you are applying for a specific fund, they might have additional criteria. They might have additional prerequisites. They might have additional things that you would need to comply with before they would consider borrowing you money. The first thing, though, they would typically ask for is either 6 to 12 months of financial statements. You would need to supply your actual financial statement in addition to the bank statements. So the AFS, which is your annual financial statement, that is a compilation of your income statement over the last 12 months, your balance sheet, which is everything the company owns and everything the company owes, and your cash flow analysis, your break-even, and a few other things that are important financial information that speaks to the health of your organization. Right? Some organizations would need to have made a minimum turnover of X per year. I know when I applied to DTI funding a few years ago, the minimum criteria was I would need to have proved turnover of at least 250,000 rand per annum before I would be eligible to apply. Then they would also require you to have a clean credit record, especially private sector funders. Public sector funders, they have a level of leniency, but you need to prove that you have payment plans in place with these creditors to show that you have not just gone into financial delinquency, but you've actually taken the responsibility, putting payment plans in place, even though it's not the full amount, even though that account will not be paid up within the next 2 to 3 years, but it might be even longer than that. But they want to see that there's a level of effort that is being made, that you're not running away from your responsibility. They would also need 12 months financial projections. So in addition to the financial statements, projections gives them an indication of what does the future look like for this business. And the projections need to be realistic. In most cases, they're looking at a 10 to 15% increase year on year. If it's anything more than that, if your business shows that you had a turnover of 250,000 Rand per year 2 years ago, then it increased to 270,000 Rand, and then last year it then increased to 300,000. Now your projections for next year is 800,000. That is what they call hockey stick figures, right? Because it's a sharp increase, it's a rapid increase. Now in some cases that does happen when things like AI is introduced to your business and what that then does, but you would need to be realistic. And if you show sharp increases in these projections going forward, there needs to be a level of understanding as to what has contributed to that sharp increase. Those are the things that business owners and funders look at before they assess the viability. Then, of course, they would need to make sure that you are CIPC compliant as well as SARS compliant. And SARS is obviously the South African Revenue Services. In some cases, they would require you to have collateral. Government, not so much, but some private sector funders, they would insist on collateral, and not all of them. Some of them are unincumbent. Some of them are unsecured funding. Sorry, that's the word I was looking for. So some is unsecured funding, and others, they would require you to have collateral in place. And then if you live in the Far East, some of them would require you to be married, stable, with kids. So these are just some of the examples. The last one was a joke, by the way. So some of these are just examples of qualifying criteria that you need to comply with if you are looking at getting funding. Now, if you are a business owner and you don't have a good credit record, but you need to get funding, right? And you don't know what else you can do, there might be a few other options. Okay, so the first one would be to explore the option of self-funding. Now, if you are a service-based business, that means that you don't have to invest heavily in equipment, you don't have to invest heavily in stock, you don't have to invest heavily in staff, because most of what you are offering is service-based. So there, when a funder says, listen, you are a service-based business, why do you actually need funding? Maybe there's an opportunity for you to do some introspection, ask yourself, the funding, is it just to give myself a runway? Is it just to give some working capital and ease some of the pressures of going into business? Funders, they're not too keen on funding that. So you need to be very clear. Now, if you are self-funding, it doesn't sound very sexy. It doesn't sound like the ideal scenario that you had in your mind to start this business with, because self-funding means that you'd have to bootstrap. You won't be able to do it at the level of quality and innovation that you've envisioned this business to start. And maybe you can do that and offer lower prices because you have to compromise on quality until you get to a point where it starts building momentum and it starts snowballing and you start getting traction. And then at that point over there, you can then go into the initial vision that you had with regard to this business. The second one is alternative funding. Now, this is new and this is up and coming. Now, although it is new, it has been around for such a long time. And I know it's a bit paradoxical, but let me explain what I mean. Alternative funding, I think the prime example for alternative funding is crowdfunding. Now in South Africa, a group of people were excluded from the formal economy. And they had to find their own way to raise capital. They had to find their own way to tap into the benefits of economies of scale. And that is where they started the stokvels, right? Now crowdfunding is not too far from stokvels. Crowdfunding is bringing a group of people together, asking them to commit to a small amount, which in the crowd contributes and gets to a bigger amount. So in the business sense, it's a matter of just tapping into the crowd. Now, there are organizations out there that assist businesses and individuals when they're looking at raising capital. Here, you don't need a good credit record. You just need to have a bankable business. There needs to be some form of reward to the donor that is giving it, unless it is a donor-based give and not a reward-based donation. Those are some examples of crowdfunding. Now, there are some organizations out there. We are in the process of launching a fund that speaks to this need, but more information about that will be shared later this year. And then the last one is franchising. Now, this is an interesting one because when I proposed this, a lot of people were, okay, what do you mean by franchising? Now, firstly, before you are looking at raising capital through franchising, you would need to have a franchisable business. Now, a franchisable business would be a successful business that has either a brick and mortar store or an online store or something where a system and set of operations can be replicatable into a different geographical territory. Now, if you're running a cafe or a clothing store, right, or a tax agency, and you know that this business is done well, and you want to replicate the success of this business into a different geographical location. So let's say you're in Cape Town, in the southern suburbs, and you want to replicate it in the northern suburbs, or you want to replicate it in Johannesburg, or you want to replicate it in Namibia, then you can sell a franchise license. And that is where you can get CapEx. Now, I'm obviously simplifying the process. There's a lot of things that you would have to comply with before you are franchisable. So the first thing you can do is you can sell a franchise license. And depending on the nature of the business, this franchise license can go from anywhere between 30,000 to 350,000. If you are selling a turnkey solution, so let's say you are selling a cafe or a restaurant, in addition to the franchise license, because it's a turnkey solution, you're also doing the fit out, the due diligence, the process that ensures that the location that you've identified is a good enough location. It ticks all the boxes that would contribute to the success of this business. That could go for anywhere between 250,000 and 7.5 million rand. And in another podcast, I'll actually unpack some case studies about franchises, and that will give you a better indication of what are viable franchises, what do I need to know about those franchises before exploring or before going into it. And I'll also interview some franchisees and franchisors so that they can share their experience and their take on that as well. Now, in addition to getting capital from that, you also get some operating income, and that is through royalties, because they are trading under your brand, which you've really built up, and it's created a level of trust that increases their chances of selling the product. That is something you can charge for. Now, under operating or under royalties, a portion can be allocated to marketing. A different portion can be allocated to additional support and resources that you as the franchisor would offer your franchisees. And there are also other forms of ways you can get money through that, like a loyalty program. And we've come to the end of our show. So in the next show, I want to unpack Starbucks' loyalty program and how they now hold in excess of $1.5 billion, which they then use to open up more Starbucks stores, all because of a well put together loyalty program. But more of that on the next show. So thank you for taking the time to listen to this. If you got value from this podcast, please send us an email or send us a WhatsApp. If you'd like the notes of the show, send us that email as well, and we will gladly pass that on to you. Until next time, goodbye. God bless.